We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Christopher Aaron, founder of iGold Advisor and Elite Private Placements. How are you today, Christopher?
Doing fine. Thanks, Tom. Thanks for having me back on the show.
Always great to have you and, have a chat about how you're seeing the markets, what's interesting you, and, just get a perspective on really this kind of lazy summer for gold and a lot of assets here.
Yeah, it really has been quite a lazy summer here for the precious metals. Lazy couple years, to use that phrase. It's actually been quite extreme what we've seen here over the last couple years. When we look at the comparison between price of gold, which is 5-6% away from all-time highs, and we look at the valuations of a lot of companies that are involved in digging that precious metal out of the ground. Across the board, when I look at the valuations of companies involved in the business of gold, we're talking the majors, the large cap companies, your Newmonts, your Agnico Eagles. These companies are down 50, Pan American Silver down 60% for a lot of the majors. And then when we look at the smaller companies that are engaged in exploration or developing deposits, I mean, a lot of these companies are down 70, 80, 90% from where they were just 3 years ago, when we have gold as a net sum, which has basically moved sideways, plus or minus 5 percentage points on each side. But gold is effectively sideways from where it was 3 years ago. Mm-hmm. And in my opinion, this is largely a function of psychology. It's what I've actually noticed in my own business and working with investors in monitoring statistics across, readership, viewers of videos for one of the sites that I publish articles on, for example, the readership. I've noticed that the worst backdrop for investor psychology is when an asset class moves sideways. That's when people get tired. That's when they throw in the towel. You actually have more interest in a sector when the price is moving lower compared to when it's moving sideways. So this sideways type price action here that we've seen in gold for the last 3 years has really taken a toll on investor psychology. And we're waiting for something to give us resolution as to whether this is going to finally resolve to the upside or whether gold is putting in a long-term top right now as we're speaking.
Yeah, it seems like everybody's just kind of waiting for a catalyst here. And, I think the situation in the gold mining sector is especially, let's say, affected negatively by this sideways price action, because as you say, it's not like gold has come off really a substantial amount, yet the value of a lot of these mining stocks have gotten absolutely crushed. So I can see why there's a lot of people that have lost interest, have lost maybe conviction, whatever it is. And maybe it's not necessarily that they're never going to go back into mining stocks, but there's a lot of other things that have captivated other people's interest, not just that people only look at gold and gold miners, right?
Yeah. And so what I would like to do is to sort of share with investors the way that I approach these markets, which is, I believe, different from how most investors approach the markets. Most investors start with sort of a fundamental viewpoint, and they say, well, there are problems in the economy. There's too much debt in the system. Fiat currencies all trend towards zero over the long run. The bond market is in a bubble. And all of those things can be correct. And in fact, most of those things are correct. So don't get me wrong. But most investors start with a set of fundamental beliefs like that. And then they do a ... Therefore, I expect the price of some asset class, whether it's gold or the miners, to do A, B, or C. So they start with the fundamentals and then they extrapolate what the price action should be. I learned the hard way when I was cutting my teeth in this sector, 2007, 2008. I learned the hard way that that is a very dangerous way to evaluate the markets. A lot of the individuals who correctly understood certain fundamentals leading into the global financial crisis in 2008, they were completely blindsided. I'm not going to name any names, but they were completely blindsided in the crash of 2008 that they could be right on the problems in the housing market and the mortgage market. But the way that they then invested, they actually got hurt more than even the mainstream stocks. So, for example, silver fell more in percentage terms than the S&P 500 in the crash of 2008. A lot of the mining stocks fell more than the S&P 500 in the crash of 2008. So when that happened, I was taking notes at the time. This is going back 15 years ago. And I was saying, okay, you can't invest based on fundamentals alone because you can be right on A, B, or C fundamental, but we cannot extrapolate that to mean that X, Y, or Z is necessarily going to happen. And by the way, the reason for that, Tom, for people who are students of the markets in general and not just precious metals investors, but the reason why one cannot start with a fundamental outlook, unless you have insider information on a particular story, you know something already before the market knows it. But that's a rare case, and that's an illegal case that we're not really talking about here. But for 99.9% of investment cases where you're dealing with the sum of the information and you're trying to extrapolate price expectation based on the sum of information, you cannot do that because there is no humanly possible way to know whether the 1, 2, or 3 fundamental narratives that you're gravitating toward, there's no way to know if that is all of the fundamentals that are impacting the market, or if, let's say, that's only 3 fundamentals over 100, 3 over 1,000, 3 over 1,000,000. There's no way to know what percentage of the fundamentals those are. There could be 1,000 equally valid fundamentals floating out there in other aspects of the world that we live in that are beginning to exert influence on the market, which myself or an individual investor is simply not aware of. And because of that truth, because of that reality, and because of my experience in 2008, following a lot of these fundamental based analysts, following them downward when the markets got clobbered, I said to myself, I'm going to do the only logical thing that one can do, which is to place foremost emphasis on the price, on what we actually care about as investors, the price of the asset. And then whatever fundamentals are happening in the background, let that be debated amongst the people who like to talk to their blue in the face. But why not focus on what actually matters to us as investors, which is the price of the damn assets that we're talking about? Mm-hmm. So that's how I approach the markets.
I was going to say you might be focused, let's say, on 2 or 3 narratives that you're replaying in your head. And it's not even necessarily that you're not aware of the other ones, but it could be just that you're missing the other ones because you're, let's say, have tunnel vision focus on the 2 or 3 that should be working. I know, when I started learning about this stuff, there was the financial collapse was imminent, over 10 years ago. And we were still kind of waiting for a dramatic collapse in the way that was described back then. So, it's always important and interesting to have these types of conversations to figure out where this thesis or these narratives might be wrong and not always be married to this idea that the fundamentals say X, so I only believe that this market will move in X direction, right?
Yeah, that's such a great way to put it. If I could just extrapolate on that a little bit further, the analogy that I would use is like if you're looking at 3 or 5 or 10 sets of fundamental data points, but you have those blinders on where that's the only set of data points that you're looking at. It would be like, if you're sitting in your hometown and you're looking outside and you're saying, there's a storm here, and you're correct. There's a storm. There's wind, hail, rain, lightning, a mudslide happening in the back. You're 100% correct on those fundamentals. But what is happening one state over or one province over? What's happening on the other coastline? What's happening on the other side of the storm? So to only focus on, to bring it back to the markets that we're talking about, for precious metals, for commodities, for currencies, to only focus on the problems with fiat currency, the problems in the debt situation here, unsustainable spending. To use that storm analogy, you're 100% correct. I'm not debating that one could be correct on all those things, but it's about what else is happening in the world that you're not exposing yourself to, but that are indeed impacting the sum, because the markets are the sum of all those things together.
Yeah, exactly. So, Chris, where is it that you, let's say, have kind of expanded that view to try and figure out what other fundamentals might be affecting these markets?
Yeah. So, and then let's look at some charts to kind of support this. So, I've been observing price action. We just talked about this. I foremost observe the price action. We just talked about how a lot of the gold miners are down 50 to 90% in 3 years when the price of gold is flat. And so there's a definite lack of interest in this side of the precious metals market, even though the underlying commodities are relatively flat. That's the price action. What else is happening in the world to cause this? What other price action is happening that perhaps we were not looking at previously because we're sort of narrow focused? What else is impacting this? So let's look at a few things. We'll pull up a few charts here. Foremost one that I want to look at is going to be this. It's going to be Dow to gold ratio here. And what I want to point to you here is on the bottom, as we look at this, the price of gold from the 2015 low here when it bottomed at just over $1,000 to reaching over $2,000 in the last 7 years. So we can call that effectively a doubling, plus or minus a couple percentage points here. Price of gold doubled over the last 7 years. You can very plainly see that. Now, when we just go up to the top part of this chart here, and we look at the ratio between gold and the broad stock market as represented by the Dow, exact same time scale, late 2015 through the present, we can see that, yes, with some oscillations on both sides, as a net sum, the Dow to gold ratio is flat, completely flat, where once again, the price of gold has doubled. So what does that mean? If the ratio between something that has doubled is flat, it means the other asset class in question here has also doubled. So what we're looking at here is a situation where the average investor who, let's say, has a 401k in the United States or one of the tax-free savings accounts in Canada, a superannuation fund in Australia, we all have related index funds that the mainstream investor will use to sort of invest for their retirement and not think about it too much. That mainstream investor has done just as well in their index funds, their stock index funds, as precious metals investors for the price of gold. even as both asset classes have doubled. Okay, so that's interesting. Now we have to say, well, how rare is that? Has that sort of thing ever happened before? So let's pull up another chart here. And let's look at the history of this signal. So we'll share. Now what we're looking at here is that same Dow to gold ratio. We were just looking at this period right here where my mouse is, and this sort of converging triangle between the long-term magenta rising trend and this 20-year downtrend. We were just looking at the last 8 years here. But look at the history of this Dow to gold ratio since gold has been freely trading in 1971. There has never, I repeat, never been a period of time where gold has been in a bull market, where it's doubled in value, and this Dow to gold ratio has moved sideways. This has never happened before in the history of freely traded gold. You talk about the 1970s bull market here, where gold broke the standard against the dollar at the end of the Bretton Woods Accord, when Nixon severed the link between gold and the dollar. You're right up here in 1971, as gold prices moved from 35 up to $850 an ounce, this ratio compressed from 22 down to 1.
Mm-hmm.
So it means the Dow Jones lost over 95% of its value relative to gold, as gold itself was in a bull market this 9 years right here. Then we look at the other major bull market in gold from 2000 to 2011, amidst the housing crisis, amidst the global financial crisis of the mid 2000s. This ratio moved from 45 down to 6 in favor of gold. So it means that the Dow lost 80% of its value in that 2000s example, as the price of gold moved from 250 up to 1900 per ounce. So to go back to the original point, I repeat, there has never been, this is the first time in the history of freely traded markets that we have, can you see the short-term example now here?
Yep.
Where we have the price of gold, which has doubled over the last 8 years, yet that ratio is completely flat. That has never happened before, and it is not going to continue. What I'm showing here on this chart is we're in this very long term. We're talking a generation of price action here, convergence, where these lows are coming up in favor of the Dow and the peaks are coming down in favor of gold. And within the next 12 to 24 months here, we should have an impulsive move in one of these directions, either upward in favor of mainstream stocks or downward in favor of gold. And this is going to be like a generational, a 1 to 2 decade signal when this thing breaks. And again, there's never been a flat Dow to gold ratio like we've just seen over the last 8 years amidst this rising gold price. This has never happened before. And this, in my opinion, is the principal reason why so many of those mining company valuations have languished so much here. Yes, over the last 3 years, quite acutely, but even more so, really over the last 7 years. Basically, since the bottom in gold in 2015, you've had a few brief windows where the mining companies have performed well. But aside from that, basically since 2015, it's really been a struggle in the sector. And so, what precious metals investors need to start to do is to take off those blinders of only looking at 3 or 5 or 10 fundamentals related to gold versus fiat currency, and realize that there's this much more important question, which is being decided right now in front of our eyes, which is, do we need to be focusing on savings altogether? Which, yes, gold is the premier form of savings in the world. Or is this going to be a time, if that Dow to gold ratio breaks upward in favor of the Dow, is this going to be a time, let's say the next 10 to 20 years, where we as a species make such incredible leaps and bounds in our technology capacity that the need for savings, the debate between gold and fiat assets, is really just a secondary debate altogether amongst the more important growth potential that we are on.
Mhm. So how do you kind of conceptualize that, Christopher, just to drill into it a little bit more? Obviously savings are an important part of how a lot of people, let's say, have comfort in where they are, have some financial comfort, hopefully outside the mainstream financial system. But, is it more so to be invested in other ideas and other areas? Or is it to, is it weighing, let's say, savings versus being invested?
Yes, I never want to negate the importance of savings, and every individual, of course, is in a different position. And there are times for individuals to be saving more. There are times for individuals to be saving less, depending on the individual, right? But when we look at what is happening in the markets right here, and I should add one other point, which I do think, especially physical gold, is the premier generational form of savings. If you want to crystallize wealth and pass it down to your heirs, or have it in a format that will not lose value over long periods of time, I still believe precious metals are the premier form to do that. Back to the issue at hand here, the question of, from a bigger picture perspective, not talking about any individual, from a bigger picture market perspective, is this a period of time to be focusing on savings, or is this a period of time where, let's say, we are about to make some leaps and bounds as a civilization, that say that now is actually the time to be investing in the growth of our species, the growth of technology, the growth of our capacity? The best analogy that I can draw to the present time is to imagine, go back in your minds, your lessons from history, and think about, let's talk about a little less than 200 years ago, during the whale oil era, 1820s, 1830s into the 1840s in the United States. The center of the whale oil industry was Nantucket Island, Massachusetts, United States, in the early 1800s. And you had over a generation of business interests that had been aligned with extracting, hunting these whales and extracting the oil from whales to use in lamps and rudimentary industry at the time for heating purposes. This was the primary way that oil was extracted from the earth as a net sum at the time. And if you were to walk up to one of these people in 1835 or 1840 that owned multiple ships and industries and say to them, hey, 30 years from now, your entire industry is going to be bankrupt. Mm-hmm. You will lose your entire investments. You will no longer be hunting whales. Why? I just heard my cousin's brother's friend in the fields of Pennsylvania just stuck a shovel into the ground and found oil seeping out of the ground. Or some guy in West Texas who's prospecting for silver in the ground just dropped a bucket. If you've ever seen that movie, There Will Be Blood, it's a great example of that. He's prospecting for gold and silver. He drops a bucket into the ground, and he happens to find oil there in the 1800s. If you were to tell the established industry of the whale oil industry that one generation later they'll all be out of business and that we'll be mining, extracting oil from the ground that occurs naturally, they would say you're totally crazy. You're off your rocker. This is fantasy. This has never happened before. You're crazy. Okay, it came to pass. I believe that when we take a major step back and we look at what is happening here for our potential as a species, to try to take those blinders off of only focusing on gold versus fiat assets. If things go according to plan, within the next 10 years, our species is going to be on the surface of Mars. So if you think about it, it took from the dawn of civilization, going back 8 or 10,000 years, up until the early 1900s, all we did is horses and walking around the planet on foot. So you had 8,000 years of horses. And in the last 110 years, we've gone from horses to the surface of Mars, let's say a decade from now. What we're actually living through is the hockey stick of the exponential growth curve of our potential as a species. And so sometimes, yes, there are these storms that are raging, and these storms are very important, and these storms can cause a lot of damage to people that are in the wrong asset classes at the wrong time, especially, a global financial crisis of 2008. But from a bigger perspective here, when I look at what appears to be shaping up here over the next decade, and maybe I'm wrong, maybe it's actually a decade beyond that, or maybe it's 2 decades beyond that. But within our lifetimes, Tom, what appears to be shaping up here, when we get to Mars, when we start exploring asteroids, when we get proficient at mining underneath the sea, when we get to the point of the alchemist's dream of actually being able to transmute one element into another, which is not all that far-fetched. It's actually happened already in some isolated instances where we have actually fabricated gold from other elements, just not at an economic level at this point. But you look at what we are capable of as a species and what could be happening here over the next 30 to 50 years. And it appears to me that there is a major paradigm shift that is going to be happening that affects not just mining enterprises, but really the global economy as a whole in front of us. And I think as investors, we need to recognize that there are periods of time to be foremost focused on this debate between different forms of savings, gold versus fiat assets. And then there are times to take that major step back and say, what are the bigger trends that are actually happening here for us as a species?
So, Christopher, how do you kind of conceptualize what becomes important at that point? Is it technology investments? Is it different commodities, whether that be, commodities that end up going into making rockets or spaceships, whatever that is? Is it the technology companies that build guidance systems for these types of things? Like, where are you starting to look for other places to invest?
So it's going to be important to not take an all or nothing approach. It's going to be important to diversify, because not all of these themes are going to be happening at the same time. And there are going to be within one theme, there are going to be counter trend themes for multi-year periods that cause the primary trend to be questioned. I mean, we see this across the markets, no matter what market we're talking about. But so with those caveats said, if one is looking to stay within the mining industry, let's say, and by the way, I just want to go back to the gold chart here for 1 second. We'll come back to this, but so that we don't get so negative here on the precious metals themselves quite yet, I just want to share.
Again, you can say 2 things at the same time, right? It's not that you don't believe in gold, but it's necessarily more so that you want to look at other things besides gold. Plus, you see a breakout in gold possible.
Exactly right. Exactly right. And so when I look at this long-term chart of gold, here we're looking at the last 20 years, 2011 peak and getting into the present era right here. And let's zoom in here on the last 5 years or so. What I see here, and looking at this trend out of the 2018 low here, which is getting tested right now as we speak. And then we see basically 1, 2, 3 peaks all matching up within a few dollars of the 2075 level up in here. So let's zoom in on these 3 peaks here. And yes, we're backing away from it a little bit. And we have an important trend test coming in here at 1880 within the next couple of weeks. But when I look at this from the big picture perspective here, just focusing on physical gold itself, I would say it's rare, very rare. I never want to use the word never or unheard of, but it would be very rare for there to be a long-term triple top. Be very rare for this 1, 2, 3 on gold, all plus or minus a few dollars here, to be the end of this cycle for gold. Very rare. So what I believe is going to happen for physical gold here, when we're looking at intermediate term time frame, next 1 to 2 years, whether this support holds here or whether it needs to retrace one more time back into the 1800s or 1700s, I still expect, from a highest probability, that gold itself is going to make one more significant peak. Could actually be quite dramatic. We could be talking into the 23, 24, 2500 level, when we're looking out 18 to 24 months here. So there is still some hope for the precious metals sector. Not hope. Hope is not a good word in the markets. There's some expectation for precious metals investors to still have a chance for this sector to perform well. It's more that when we look beyond that, these themes that we were talking about of Dow-Gold, the other thing that we should talk about is the overall strength in the US dollar, which I expect to continue. We actually see the euro right now breaking down versus the dollar. And so the dollar index itself showing strength. And that's a trend that I expect to continue over the next decade or so. So when we're looking out 1 to 2 years from now, and if we talk about the possibility of gold forming a significant top at that point, because let's admit every market is going to top at some point, whether it's sooner or later. I think when we're talking about mining going into the later part of this decade and through the 2030s, I think the major themes to focus on are going to be the raw materials that support industry and energy. The raw materials, lithium, battery metals, cobalt. Certainly in the transition toward somewhat of a more sustainable energy future, we're going to need uranium through that process to make the transition. Mm-hmm. So battery metals, energy metals. But then it's also going to be raw materials that support the growth of industry. What are the metals? What are the components that are needed for technology as we are growing as a species? So that's what I'm going to be looking at as we get into the middle and later part of this decade. Raw materials that are needed, especially for batteries, for industry, and for energy transition as a future. Then, so we're talking about diversification. So it's still okay to have some savings in physical metals as a long-term savings. Not negating that. Then within mining, I think when we look at the middle and later part of this decade, we just talked about it. But then I think investors really need to take that additional wider look and start looking at some of the growth industries here, some of the potential for radical transformation. The best way that I can draw an analogy to this is, think about if we are going to get to a new world as a species, if it's going to be Mars, if it's going to be some of these asteroids, if it's going to be a quasi new world that we explore under the ocean, think about the last time as a species that we did that, where we found a new world and explored a new world. And okay, so even if I'm wrong in the timeline, even if it's not within the next 10 years, if all of Elon Musk's rockets blow up and I'm buying too much into his hype, even if it's 30 years from now, at some point we are leaving planet Earth and we're setting our steps on the new world. Think about the last major time that happened. We go back to the discovery of North America. Let's go back to the 1500s, 1600s, early 1700s. So you're in Europe, let's say, and you're in a period of time where there's instability in the currency. The local government is spending more than it takes in tax revenue. There's a good need to be saving, yes. But if you told me that as the new world is going to be explored in the 1700s, that the best thing to do is to be keeping all of your wealth in savings as opposed to investing in the companies that are going to go over to North America, start trading with the Native Americans, start extracting minerals and timber and wool and furs, and start trading internationally. And then the companies that are going to be set up to start developing the new world. If you're telling me that the most important thing to do is to focus on saving at a time where we are literally exploring a new continent, that's way too narrow. It's way too limited in its scope. And so what it appears is, to draw the analogy here, right now, we are seeing the bubbling up. We're seeing the very beginning of the reverberations of the potential for us to be discovering new worlds or new applications for technology that change our possibilities in life. And so I do believe that when we look over the next 10, 30, 50 years, it is going to be extremely important to not only focus on the raw materials that are needed for those transitions, but on the actual enterprises themselves that are going out and that are doing the exploration and the life transforming types of work.
Yeah, I like that idea of how you're explaining that, is to, be saving in a time when frontiers are breaking in a way, and we're exploring these new things. Without investment, a lot of those developments wouldn't have happened. So, from a free market standpoint, that drives that innovation, those new domains, and investment is paramount to be able to do that, right?
Totally right. Totally right.
Christopher, going back to something that you mentioned there, I wonder if we could just touch on it really quickly, was you were talking about the Euro versus USD chart. We've talked a lot about the BRICS nations making steps towards making an alternative currency to facilitate trade between them. But you have an interesting perspective, I think, on how this story progresses.
Yeah, and the key word there is story. So many of the people in this industry, in the investment industry, are literally storytellers. Their job is to tell you a story, and they get paid if you click on the video or on the article. They're storytellers, and that's exactly what all of this talk is about. BRICS countries making a new currency, or China going to start trading exclusively in yuan with Russia, or they're going to abandon the petrodollar in the OPEC countries and move away from the US dollar. It's all stories designed to extract a fee from you. So when we go back to the actual data, the actual price data, first we will look here at the largest trading partner with the United States, which is the European continent. So what we're looking at here is all of the available history between the euro and the United States dollar. This is a 75-year timescale. Please do not ignore the timescale down here, 1974 through 2050. And what we're looking at here, when we zoom in, I know I have a lot of colors here and I don't have the normal key that I would use, but know that these pink magenta trends are really designed to stand out in your eyes as the primary trend in play. Mm-hmm. And so notice here that the lows from 1985, we extend these trends through the lows of the 2000 era. You have a best fit and an absolute low. So there's a slight expansion in the trend here as we look at euro to USD. And then notice how that matches with this low in here in 2016 and this low in here at 2020. The point that I'm trying to draw to people's attention is that trend, this is a 35-year rising trend in favor of the euro. That trend, if I zoom in right here, has been broken quite decisively. And not only has it been broken here, after the initial downward thrust, the retest, the attempt to get back above the trend, the attempt to say, hey, maybe that was a false type of event, that is failing in front of our eyes. You can zoom in here and see this rounding over right here. Notice that wick on that candlestick failing to get above, not a random line. That's a 35-year broken trend here. Mm-hmm. So when I see, so remember, we're looking at the euro breaking down versus the dollar. So when I see that on the largest trading weighted partner for international trade between the United States and Europe, when I see that on that major constituent, what it's telling me is that there is no indicator whatsoever of weakness coming in the United States dollar over any sort of a real world usable time frame looking forward for perhaps decades. You got a 35, almost a 40-year rising trend that has just broken now in favor of the dollar. We could be looking at 35 to 40 years of dollar strength coming. These things tend to move in generational types of cycles. That's how things look right now as we're trading at 106, just below 106.5 on the euro to USD. I always have a point, by the way, Tom, on the charts where I admit as an analyst, I don't have complete knowledge. I don't know everything that's going to happen in the future. I can read the message of the charts, and I think I can do that in a way that other people are unwilling to do when they're married to these fundamental narratives. But there's always a point when I'm looking at charts where I say, hey, we had a false signal. Hey, something else is happening here. And so if I were to see this level, this upper band of this 35 to 40-year trend recovered, which right now, if we zoom it in here, would come in at the 112 level. If I were to see 112 recovered on euro to USD, I would say, wow, this was one big false signal. The market just gave us one of those rare false signals. It threw us a curveball. Markets like to do that from time to time. And from then we'd be looking at a very strong move in the opposite direction in favor of the euro. However, I take the markets for what they are. And right now, as we're speaking, the markets are not showing me that. The markets are showing me that this break in favor of the US dollar lower is for real, and that the dollar should therefore should be expected to continue to rally versus the euro, but not just versus the euro. Let's look at one other chart here for a moment.
That's what I was gonna ask you, Christopher, because we're looking at in that chart just euro versus USD. So could that maybe just mean, let's say, strength of the dollar versus euro, so death of the euro, let's say, and not necessarily meaning that in a broader context of the world.
Yes, it could. And of course, when we're talking about battles between fiat currencies, we know that over the long run, they are all going to be losing value to real assets over time. But for a moment, we are talking about the battle between fiat currencies. You know, I believe that was sort of the original question here just a few moments ago that we were talking about. What about the US dollar? You know, what about all these stories that we see in the media about the death of the dollar? And so to come back to that, if we look at the dollar index itself, which is more widely representative, not just the dollar versus the euro, but the dollar versus a basket of 7 different major currencies. When we look at the trend out of the 2008 lows, so pay attention to the magenta, the bright pinkish kind of lines here, just a broad rising trend here for the last 15 years. One little false breakdown there in 2011, but otherwise higher highs and higher lows. And so remember, we're talking about multiple themes here at the same time. We're trying to broaden our focus to not just talk about the battle between fiat currencies, not just talk about fiat versus real currencies, not just talk about technology, but we're talking about it all together in this conversation. Yet in this particular moment in time just to narrow in on the battle between fiat currencies? And is there any indication that the dollar itself will be losing its status as the world reserve currency within any point in the real world meaningful time frame? Let's talk about within the next generation. There's zero evidence for it. There's zero evidence where it actually matters, which is on the charts. Mm-hmm. If you want to go out and scan the internet and pull 10 different headlines from different websites about different stories, fine, do that. But it's not going to result in any change in what's actually happening when we look at the price data here, which is only indicative of strength in the US dollar going forward.
Excellent, Christopher. You know, there's so many different ways to look at these things, and I've said it, I feel like a broken record. You know, getting these different opinions and getting these different viewpoints to be able to kind of triangulate a position in the world here, I think is really important. And I appreciate you giving us your thoughts on not just having these blinders on and only staying focused in one direction.
Yeah, thank you, Tom, for saying that. If I could make one more point, would that be all right here to close this out?
Yeah.
I think this is really important because I myself am a precious metals investor. I have been for over 15 years. And so I understand what goes into the psychology of being a precious metals investor. There is a sense that by investing in precious metals, we are fighting the good fight against the corruption of central banking, fiat institutions, which I agree. Central banking, fiat currency, the entire thing is an abomination. I think central banking should be eliminated. I think we should have free market currency. I think there should be no central control of interest rates or currency whatsoever. It's a system of theft and a system of corruption. 100% agree with that. That said, we can sometimes become so married to that narrative, to that particular battle, that again we miss the forest for the trees. And so I think it's important for investors here to start thinking about the fact that if we thrive as a species, if we in fact do go to Mars in 10 years or 30 years or 50 years, whenever it is, and we do discover new mineral deposits and we do discover new technologies to improve our way of mining and extracting resources, not just from the planet Earth, but from other bodies in the solar system or underneath the ocean, or fabricating new minerals where previously they didn't exist. And we therefore enhance our lives, enhance our health, enhance our consciousness and our abilities as human beings. If we do all that, it means that we are winning that battle versus the central powers that are trying to rob us of that potential. It doesn't mean that we're losing. So we don't need to get so married to the idea that the only way to win the battle against fiat currency is through gold. We can also win through thriving individually and together. And part of that thriving is taking a broad look at what's happening around the world and saying, hey, how can we participate in this? Because I think it's going to be really exciting. Mm-hmm. Really do.
Well, I appreciate the optimistic viewpoint, and I think reframing it in that way is really helpful as well, Christopher, is being able to thrive in not only focusing on what's in our account, but in a freedom aspect as well. I think that's really, really important because, as everybody knows, it's not just the numbers in your account that provide you the freedom. It's everything, all of the laws and the sovereignty that you retain and the freedom that monetary compensation allows you to have, right?
That's right. And let's say that if we broaden our focus here and really take a look at what the potential is for the world over the next generation, let's say we get to enjoy all those things together. We get to enjoy the higher numbers in our account and more freedom as individuals.
Yeah. I think that's the important part there. Well, Christopher, I think that's a great place to wrap up today's conversation. Of course, all of your stuff is available at igoldatvisor.com and on Twitter at iglobalgold. Anywhere else you'd like to share?
No, that's it. Thank you, Tom, so much for having me back on the show.
Thank you, Christopher. It was a great, interesting, wide-ranging conversation. I appreciate it.
Likewise. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.